Okay, just to kind of hammer home the idea of how we have operating expenses versus non-operating expenses, the next page really diagrams out to you the structure of expenses and how expenses are really, parsed out within a company. So if we just have this one big bucket of expenses up here, we can parse it out between operating expenses and non-operating expenses. Okay, within the operating side, so I'm just going to facetiously choose Chipotle again. This would be about the business of making burritos. Making burritos. Okay, and the non-operating stuff really is about, financing and not, or I should say, or not about making burritos. Not about making burritos. Okay, let's go to the operating side. So, from a manager's perspective, kind of like on the ground manager's perspective, so not like the CEO or anything like that, the manager can control some expenses and the manager cannot control some expenses. The expenses that a day-to-day manager can really control, right, are in the prime cost area or other. So prime cost wise are the most important costs to the manager. And that starts off with cost of goods sold, right? So for Chipotle folk, it's probably like food and beverage expenses, because presumably the day-to-day manager can control food and beverage expenses. The day-to-day manager can also control labor. And these are probably the two biggest expenses that restaurants will have, and so that's why they're called the prime costs. Prime costs are just cost of goods sold plus labor. So on the labor side, right, you have a couple of different categories of cost. You have management's labor, so other like, a shift manager or the night manager, the swing shift manager or whatever. You have management salaries here. You have the staff, so that's usually hourly. So these are salaried and these are hourly. And then you have benefits for everybody along the way. All of that falls underneath labor, okay? And so your prime costs are cost of goods sold and labor. So, and those are all controllable costs. Other controllable costs that a manager may have on a day-to-day basis is of direct operating costs. So for a restaurant, direct operating costs could be like, the tin foil. It could be the spoons that the Chipotle people use to scoop the meat onto your tortillas. It could be, the aprons, the linens, the uniforms that the employees have to wear. It could be the trash cans that they have to buy, right? These are direct operating costs. The music that they license to play inside the store is also controllable by the manager on a day-to-day basis. Any marketing and promotions, probably controllable by the managers. Utilities, right? Whether or not you turn off the lights, whether you have overwatered the plants inside the garden outside, whether you've turned your ice machine on too cold or something, these are somewhat controllable by managers. General and administrative, it's like the cost of paper clips and Sharpies and photocopiers and, running the POS system will all fall into here. Repairs and maintenance, which repair company you end up choosing, and how well you maintain your wares. All of this stuff is generally controllable by the day-to-day manager. Okay, and remember, all of this stuff is still under the umbrella of operations, right? All of this is really needed to make and sell burritos the way that you want to make and sell burritos. Okay, but also within operations and making and selling burritos, there are certain costs that, are related to Chipotle's ability to make and sell burritos that are not controllable by the manager on a day-to-day basis. And that can include occupancy, right? Because then the lease on the place was probably negotiated way before the manager even got there. So for the most part, occupancy is not controllable by the managers, right? Occupancy, kind of the same thing as the lease agreement here. And depreciation and amortization, right? Because if they have a whole bunch of leasehold improvements, or they've leased the ice machine, or or if they bought another company and there's like, you know, the Chipotle Junior and they've overpaid for it and there's goodwill to amortize, that's not really something that the day-to-day manager can really have control over. Yet all of that stuff is directly related to Chipotle's ability to make burritos, right? For being in the business of making burritos. So those are all operating related. So under, again, as review, so under operating expenses, you have controllable and non-controllable expenses. Within the controllable expenses, you have prime costs, which for restaurants really cost of goods sold right there, right? Food and beverage and labor. Other controllable costs are still directly related to the business of making burritos. Okay, so let's go to the non-operating expenses bucket then. Okay, on the non-operations side, you have non-recurring expenses, so expenses that are just one time. It's only going to happen one time and it's never going to happen again. So that's not really about our ongoing business of making burritos. This is now in the past. It's never, ever, ever going to happen again. Non-recurring. And then there are recurring non-operating expenses. So stuff that's going to continually happen, that we're going to continually be expensing, but they are not necessarily related to the operations. So the one-off stuff that usually, you know, happens only once in a blue moon or so is we close stores, right? A store is not performing, and so we close it down, and maybe it's paying people severance. Maybe we have to renege on a lease or something like that. There are costs associated with closing a store. Other weird stuff. If there's litigation or something like that, we need to pay out, like, you know, like Carnival, right? If somebody crashes a boat, weird stuff happens, but hopefully it only happens one time. It's not really reoccurring. Impairments occur when you have to write off part of the value of an asset. Okay, so let's say we bought our corporate headquarters, and you know, let's say we paid $10 million for our corporate headquarters, and that's like the value of the land and the building. And let's say the next day, somebody builds a nuclear power plant right next to our corporate headquarters. Do you think the property value is going to go up or go down, having our corporate headquarters like right next to a nuclear power plant now? It's probably going to go down, right? So if a real estate agent comes by and says, you know, your $10 million building really only worth $6 million right now, we must impair the value of our building by $4 million. Right? Because on the asset side of our balance sheet, we're starting to think, well, what we have is not worth as much as it used to be. So a building and land that used to be worth $10 million and is now worth $6 million, we need to somehow get rid of $4 million in value, right? So what an impairment ends up looking like is on the balance sheet, on the asset side, right, our PP&E, right, that used to be 10 will now go down by 4. And then on the liabilities plus owner's equity side, okay, because we're talking about the income statement, our retained earnings account, right? An impairment is going to occur, right? And that's a cost, right? Impairment is going to go, we're going to charge that with 4, which equals a decrease in our net income, because it's an expense. Net income is going to go down by 4, and that's what's balancing out here and here, okay? Because remember, our balance sheet has to balance, okay? So we impair our building by 4, net income goes down, so retained earnings is lower by 4, and it's matched by a decrease in PP&E by 4 here. Okay, and that's really what an impairment is. It's a one-time charge, or it's a one-time write-off of an asset of ours. But presumably that nuclear power plant is only going to be built once, right? So we would only impair the asset. It's a really one-time thing. Okay, it's not going to be reoccurring, because it's not like every single year another nuclear power plant is going to be, you know, built right next to our corporate headquarters. Okay, so on the reoccurring side, right? Things that will constantly happen to our company, but has no bearing on how well or we make our burritos, or whether or not we can make our burritos, is really corporate overhead. Okay, so this is, think of, well, Chipotle is not a franchise organization. Oops, sorry. Chipotle is not really a franchise organization. But let's say that it was a franchise organization. Well, actually, no. Let's say it's part of a conglomerate. So who's part of a conglomerate? Taco Bell, right? You've seen Taco Bell, KFC, Long John Silver's, A&W, and Pizza Hut. They're all a part of Yum organization, okay? And so Yum organization also has like a CEO and, CMO, CFO, CIO, all those like, high-paid executives. They are corporate overhead. And each division within Yum, so like Taco Bell and KFC or so. So if I have Taco Bell, I have KFC, I have A&W, I have Long John Silver, all these parts of Yum, okay? Yum is going to allocate some of those costs of its CEO's salary and everybody's salary. It's going to allocate some of that overhead to each one of its divisions, right? It's not that those CEO salaries not really directly related to whether or not Taco Bell can sell tacos or not, right? It's very, very removed. It has nothing to do with the day-to-day operations of selling tacos or of selling fried chicken or delicious chili cheese dogs or anything like that, right? So that's allocated corporate overhead, but it happens every single year or every single period because the CEO gets paid every single period too. So it's reoccurring, it happens, but it's not directly related to the operations of, making tacos, of making fried chicken, of making chili cheese dogs or anything like that, okay? Interest. So this is like interest expense. So this is the financing issue. It's a financing issue. Okay, so whether or not you had really good bankers, and income taxes, it's whether or not you had really good tax accountants. But you have to pay your taxes every year, and you have to pay your interest every month and every year too. Okay, so these are reoccurring, right? But they don't really have any bearing on how well you are as a business in making tacos or not.